The things we just discussed, the Apple old school tech turnaround, rates, Brexit, what mattered today?
Actually, all three. When the European market shut down, we started to take the Brexit fear out slightly, so you saw some bidding coming back in. The idea of what they're going to do in December, and you know me, I'm a low rate guy, but I think they probably are almost forced into hiking in December. For two reasons. They don't want to look like the president has disabused them of that. And secondarily, you run the risk of, if they don't hike, the markets are going to say, wait a minute, what do they see that we don't see? So they've got to have that fear. And then finally, Apple. People were afraid that Apple was going to be right in the front lines of this war around Huawei and whatever, and that they would ban all sales of Apple iPhones. When that proved not to be the case, they came back. So point-wise in the Dow, Apple's the strongest, but all three were effective.
Quincy, we've seen these strong reversals before during this whole correction period. It feels like it's maybe climactic. It feels like it's constructive. Previous ones haven't really gone anywhere. How are you viewing this environment right now? Is it building a base? Is it still fragile?
Well, it's still fragile, but what's good news is we saw a lot of money coming out of industrial ETFs last week. That's very helpful because the argument was that people were just too calm. They weren't scared enough. That helps. Try to get the last seller out. But also what's helpful is today, seeing the semiconductors, that's the group that let us down. The semiconductors have gotten a bid. Look at NVIDIA, but look at the Philadelphia Semiconductor Index. It's moving up. You know, maybe that's a trade. Maybe it's guys who got caught, want to sell into that strength. But if we can maintain some movement, positive movement in that, that would be a very, very good sign. Also, in terms of the industrials, the defense stocks are up. Yeah. The president is, looking for $750 billion. There's defense spending all over the world. And that is a good sector to keep your eye on. It's one we've liked all along in terms of the industrials.
Tony, back to the macro for a moment here. Anecdotally, I hear Europe may be slowing. We all know that China certainly has suffered a bit of a slowdown. What are you seeing? What are you looking at closely to sort of get a grip on whether there are signs of a synchronous global economic slowdown?
Well, there are plenty of signs of a slowdown, but the question is whether or not these potential black swans will come to fruition or be seen in the first quarter of next year. And there are three big issues that markets will be dealing with right out of the chute at the start of the year. Of course, Brexit, which we're hearing a lot about today. Italy, which is still submitting a budget that the European Union doesn't like. People still worry whether the lira will come back. And of course, U.S.-China trade relations in that 90-day countdown to whether or not the U.S. imposes new tariffs on China and expands the percent on the tariffs that are already in place. And so it's these major issues markets are grappling with, and it'll be very difficult to break out of the trading range, certainly to the upside, while this is happening in terms of equities, and yields will be under downward pressure while this is happening as markets start to think whether the Fed has reached finally something closer to neutral, which market tightening, the financial conditions tightening, is very suggestive of. It's getting closer.